Hey, what's up, guys? Happy Tuesday for everybody out there. Yeah, welcome to the third episode of Tenacious Drive, and off we go, keeping up momentum, keeping up, drawing our path with tenacity and grit. I hope you guys have had an happy trading day today. Yes, I know how difficult. Saturday, Sunday, Monday without trading. I guess you guys were just eager to get back in the market, and I heard some of you were rewarded, including me. But I mean, I don't check my positions every day. As I told you, I'm a very big fan of long, long term time frames. I don't like the noise of this daily up and down, up and down, up and down. I like the longer term trends on position. I'm a long term position trader. And having this said, I'm not here to talk about myself. I'm here to give you a gift. Yes. A gift. Why is it? And how did I find this gift I have for you guys? I was today. I saw that oil was not performing so well yesterday. Uh, I saw that some oil stocks on Friday did not close with very beautiful candles, not at all. Very wrong. I'm very invested in oil right now. I received a lot of triggers over the past 2 months, 2.5, 3 months. I received a lot of triggers for oil. Nothing much. I barely looked at my portfolio and just looked at a couple of them. Whenever I receive exit trigger, I'm gonna get it and just lead a trade. Meantime, as a long-term trader, you can endure for these short-term spikes and sell-offs. Getting back to where I was going through the commodities, and I, one of the perks of using the monthly time frame or the daily time frame is that you end up finding these humongous, gigantic and strong trading setups right before your nose. And something that I found, I was very curious. It was while I was checking cocoa futures. Look at this beauty here. Do you see what I'm talking about right now? Can you see it? What I do? Hell yeah. It's a beautiful not ascending, excuse me, a beautiful symmetrical triangle, like Minervini likes to call it, like a VCP, volatility contraction pattern. Hell yeah. It's sort of let's first draw the trend lines and try to make sure it's you guys are well aware where the triangle is, what are its edges, where it is situated, and, uh, and traditional technical analysis tells us that in order to draw a valid trend line, you need to connect at least three um, touch points. We have one, two, three, four. Yeah, I do say there's divergency in the doctrine of traders and investors out there. A lot of people say that it should not cross these wicks with your trend line. I think that you also have to bear in mind this is not meant to be a line. This is meant to be an area, a range, where in this case bears should be and pushing the price down. And this is what they show us when they push the price down. These candles with wicks. I'm pretty sure all you guys are versed into candlestick analysis. This pretty much says that at certain point the price was here and it was pushed back again to this place. So these candles are so powerful. Um, so let's draw the downside down edge of our triangle. Yeah, we got the same validity for our trend line. One touch, two, three, four, five, six touches. Wow, that's a lot of touch. And what does this chart pattern for shadows? You ask, and I answer, I am not a wizard. That's not what I do in sun training. We're not here to forecasting anything. You're just here to react, to be very quick and to be very good at reacting and to sort of try to understand what kind of scenarios you can expect from this trade. Um, yeah, yet again, I have no bias here, right? Really, if you get, for instance, let's say an ascending triangle, then I would have a bias. I like this sort of setups. I like ascending triangles or descending, for the simple reason that there's a lot of clues on the price action already. Is you see that, for instance, in a ascending triangle, you see that, for instance, you have the triangle starts with a strong momentum move from the bears and from the bulls, and then the next thrust is not so powerful from the bears, but the bulls are still here and holding the price a little bit above than it was before. The bears get like progressively weaker. The bulls are able to hold on the price and keep it like above the previous swing low, on and on and on. And this is normally a good indicator that could be a breakout. Always wait for the breakout, and always wait for the breakout cannot to be completed in order to avoid more whipsaws. Because even if you wait for a candle to complete the breakout, then the odds are you are still going to be whipsawed, or you're still going to be victim to a fake breakout. It does happen. It's part of doing business. Um, but I like this setup because it sort of tells me that they're good odds of a nice upside breakout. And same follows, by the way, for descending triangle. Yeah. For descending triangle, same follows. Bulls weaker, bear stronger, volatility contracting. Boom. This gives me also good feelings, good sensations, good chart sensations. I don't know if you guys are familiar with those sensations. When you see something pleasant in the charts and you're like, there's something out there. More on this pattern, by the way. Why do I like it? If you're like read some nice material and technical analysis, you've also for sure already read somewhere that a lot of nice content out there about technical analysis. That the markets move from volatile markets, from volatile market conditions, yes, to into less volatile market conditions. Expansion and contraction, expansion and contraction. That's how the markets work. So what I saw you, that the price, the market was very volatile here, and now just messy. It's just very contracted. It's just confined to this small range, this small area. And it does tell me that when it breaks out, it might break out with an explosive move, whichever direction we have. Now, yet again, we don't have a bias with this sort of this type of setup. So what do we do here? We forecast both possibilities. As to do something like this: breakout, possibly retest, and then move on to the direction. Ideally, normally, I've seen them breaking out in one direction and then just whipsawing you. But this is what they typically do. And what are your targets? Next question. I see that this could be a resistance area. This could also be resistance area. Yeah. So keep our targets here. For instance, our entry trigger. Either this breakout, or if you miss it, and then the price retest this and retest the origin of the breakout or the trend line, so to say. Yeah, you could have something like this. You really gotta quantify your stop loss. I like it. I normally what I do. And I'm not between these type of setups so often. I have a system I've developed for myself with a specific set of rules which I do follow, and I promise myself that's the only thing I'm never gonna trade, because that's the only thing I've fully quantified myself. Although all textbooks, all the all the experts out there are going to tell you that this sort of setup is something with nice odds of success. Um, Yet, okay, quantify it. Normally, if you do trade this, say for instance, go for a 180R buffer stop loss. So 180R before your entry points, in order to give the trade some buffer to allow it just to come here and get back, not prove you wrong like within the slightest of touches in a stop loss, and then the price gets back to where it was going and it like wiped out. You're out of the trade. So give it some buffer. Usually 180R below. It can have a rule, of course. This is an instance. 180R also the reason is if it moves 180R below the entry there, then there are good odds that you're wrong. Um, but come up with a rule of your own for setting up your stop loss without having the price too close to your entry, because then yet again one slight movement against your trade and you're out. Whereas the market could as well go up. Quantify it, define a target for it. If you're not targeting the next resistance area, you can even trace it. So 10 MA, for instance, 5 MA multi time frame. I like to use on the lower time frames, as in the week. I like to use a 10 MA, for instance. Um, Up to you. Or trailer stop loss as into encompass the next swing eye. So we got a swing eye, swing low, swing eye, swing low somewhere around here. You trace it, and the price would get back to this level and go again. You raise your stop loss below this resistance level, which now should act as support when the price gets back here. Your stop loss makes sense for it to have a stop loss here. Conversely, on the other way, if, and this is also a feasible scenario, we don't know. We cannot. We're not experts on what the economy is going to do. What are the commodity markets are going to be doing. All the crops behave like over the past year and so on. We just look at price, analyze price, and something that's a feasible scenario the price can do here is to break below this trend line, retest. It doesn't have to retest, but it's something that it has been doing over the past years. Retest and bomb, bearish direction. Same exercise, target somewhere around here. Can trace it in the ways I've prescribed, and that's it. This is our text. Thank you. Text book symmetrical triangle. Am I running it right? Hope so. And hope you guys enjoyed this little gift for today. Now, since I've made this analysis in my favorite, in my so beloved the monthly time frame, all you have to do is to wait 5, 6, 7, 8 months. But I mean, keep it in the back of your mind, and bear something else in mind. Whenever you're trading in lower time frames, another rule of thumb you should have as to how the markets normally behave or tend to behave like is that the markets respect first and foremost the longer time frame. So let's say, for instance, I have a breakout on this direction, on the upper direction. If you see a bearish opportunity on the lower time frame, which might as well be feasible, look at this. There's a lot of a price action if you lower down. Look at what needs to happen. Talking about the day time frame. If you see a bearish direction out here, just be careful because at this point, if you're trading short, bear in mind that you might be trading short against the longer term time frame, longer term trend also, which is not prone to set the odds on your side, which is what you strive for as a trader. Odds. Live on the odds. 51.49 is good for us if you repeat it over the long run, long enough. So that's what I try to do. And okay, that's it for today, guys. I hope you've liked it. I hope you've enjoyed it. I hope this chart within a couple of months can be helpful to you. I'm pretty sure it will. I'm gonna keep it in my radar also. And see you guys next time. Happy trading for tomorrow. Remember to manage your risk, please, 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 please. This is so important. You guys have no idea. This is so important. This is rule number zero, 1, 2, and 3. And take care, guys. Happy trading. Cheers from Ruben and Tenacious Tribe. Um, oh, of course, and then the go for action, as they say. If you like what I did here, and you sort of want to encourage me to keep on going, which I will anyway. I like it. Feel free to to hit the like button and drop me a comment and share my video and all that stuff that all YouTubers ask you to do. Take care. And if you want to interact, if you have any doubt, I love to talk about trading. I love to talk about technical analysis. I love to develop myself. I'm not Warren Buffett. Uh, I'm not Rainer Thiel. What's not? I'm not a gigantic authority from this market. I'm always here to learn. I know my share. I know my share chunk of trading and technical analysis. I'm not number one authority in the world, so always keen to learn. Always prone to learn. Take care, guys. Cheers.